Hey everyone, and thanks for jumping back into the Macroverse. Today, we're going to talk about the most recent CPI report. We're going to be discussing headline inflation, core inflation, that with respect to the Fed funds rate, and so on and so forth, maybe how it affects things in the labor market too. Perhaps we'll also talk a little bit about its effect on risk assets like Bitcoin and alt Bitcoin pairs and Bitcoin dominance. But the reality is I've repeated myself about 10,000 times on that front. So while I might say it again, you already know what I'm going to say. Headline inflation came in today about where expectations were. Okay, so if you actually go look at expectations, consensus was calling for about 3.4%, and it actually came in at 3.4%. Same thing. Now, technically speaking, if you look at it, we can see, because we have two decimal places here, you can see that it actually came in at 3.36%. So the 3.4% is actually rounded up from 3.36%, but it was at least a step in the right direction, right? It's progress. It's not a lot of progress. And then, frankly, if you look over the last year, it's basically no progress, but it was at least progress from last month. Now, again, I've talked about this a lot. I know a lot of people are worried about a second wave of inflation. I know that is what is on a lot of people's mind. And you can't really blame them, especially considering when you look at the 1970s, we had multiple rounds of inflation. We had three clear and distinct waves that made life very, very difficult. And you can see the S&P 500 during that time was not a very fun market to be in because it just kept going up and putting in new highs and then going back down and putting in new lows. So that was a fairly brutal market back then when you had multiple rounds of inflation. And so you have, once again, people worried about a second wave of inflation. As I've said before, if you get a second wave of inflation, it's likely not going to be this year. I'm not saying it can't happen. I just think that if it's going to happen, it probably wouldn't show itself until much later on in 2025 or even 2026. I think the bigger risk in the short term could be rapid disinflation, which obviously for people, for people at the grocery store and that sort of stuff, that's not a bad thing, right? I mean, I don't really think there's a single person watching this video that wouldn't like some of these prices to come back down. I mean, again, we've talked about this before. When you go to the grocery store today, you're spending a lot more than you ever spent 4 years ago. A lot of us would love to go back to those times. The reality is while you might experience deflation at some point, you're probably never going to go back to the actual prices on a lot of things that we had back in 2019. It's really hard to go back to those levels. It's not impossible. It is possible, but you have to imagine that the Fed would likely pivot far before anything like that were to happen. Again, their goal is 2% inflation, not deflation. So if they get to 2%, you have to imagine, or if they're en route to 2%, you have to imagine they will likely start to pivot their monetary policy. So in the short term, inflation, I still think there is a risk of it actually, not, maybe a risk isn't the right word. I think we all want to see it go down. I think there's a bigger chance that it goes down over, say, the next 6 months than up. Over a longer period of time, say 2 years from now, that's where it becomes a lot more murky. Now, over the last year, you've had people calling for a second wave of inflation. You've also had people calling for deflation. And the reality is that both sides have been wrong. It's just gone sideways. And we talked about how that last percent is the hardest percent to achieve. It is so difficult to go from 3% to 2% because essentially what it reflects is sort of the taming of animal spirits. And that's not an easy thing to do. And so if you do see it break down to 2%, then it could mean that the animal spirits have finally been tamed and that inflation can finally be allowed to fall back down to 2%. It's still inflation. There are people that'll say things like, well, people are saying we're seeing disinflation, but prices are still going up or they haven't come down. Again, disinflation does not mean that prices are going down. It just means they're not going up as quickly as they were before, which is at least progress. Okay, so I mean, in the short term, we've seen over the last year, anyways, we've seen inflation basically stay between 3 to 4%. We said previously that inflation would not go down monotonically. It would be a stochastic process, and that is the case. The reason why I don't think we need to be worried about a second round of inflation just yet is because the Fed has not pivoted just yet. If the Fed had pivoted already and inflation were not showing signs of durably going back down to 2%, then I think it would be justified to more so worry about a second round, a second wave of inflation. But considering that the Fed pivot has not yet occurred, considering that they have not yet begun to expand their balance sheet again, I still don't think that is the primary risk. It could become the primary risk in about 1 year. But right now, I still think that is not the primary risk. I mean, I know there are certain things that have been going up. If we go look at some of these, I mean, you have cocoa, which went up a lot. It has been pulling back. I believe copper is also something that has been going up recently. And we do know that can put upward pressure on inflation. But in the short term, I still think that even if those things are going up, they're probably not going to, they're not going to go up forever. They will likely come back down in short order. Maybe not to where they were before, but I still do think that there are a lot of forces that could still lead inflation to staying below that 4 to 5% level for at least the rest of the year. Now, I want to show inflation year over year per category and show why, despite the fact that some sectors are showing, more inflationary pressures, there are other sectors that are not. For instance, food and beverage inflation continues to slowly drop, right? And it's actually at 2.21%. So if the Fed only cared about food and beverage inflation, they're already at their 2% objective. Unfortunately for the Fed, there's more to inflation than food and beverages. You also have housing, which showed a bit of an uptick last month from 4.55 to 4.65%, but now it's back down to 4.52%, a new low. Okay, and remember, the housing sector does lag. If you overlay it with the food and beverage sector, you can often see that the food and beverage sector tops out well before the housing sector tops out in terms of year-over-year inflation. Also, food and beverages tends to drop a lot sooner than housing inflation. So it is true that housing inflation is still way above the target. I mean, it's still at 4.52%, but it is dropping. And other indicators, like other components of CPI tend to lead housing inflation, and those have been mostly dropping. So you have food and beverages, which is dropping, and you have housing, which is dropping, but not as quickly. But again, historically, it doesn't drop as quickly. It's a slower move, and that's going to continue to provide a headwind, I think, for CPI. That doesn't mean it's going to go to 2%, right? But I still think, especially as you get out of the Q3, Q4, I have to imagine, especially as we get out of sort of the peak season for people that want to buy homes, I would imagine that, or at least rent and whatnot, I would at least imagine that you're going to see inflation continue to drop in the housing front. Apparel, on the other hand, has actually started to go back up recently after being deflationary for about a month. It's now back up to 1.35%. Not that concerning. I mean, you're likely going to see it oscillate here around that zero mark. And oftentimes, apparel does tend to go deflationary at various cycles, so it's not that much of a concern to me. Transportation has started to go back up recently over the last couple of quarters, hitting a local top here at 4.02%. It's back down to about 3.5% now, so hopefully that one comes back down. Medical care, this is the one that received a lot of attention about half a year ago when it went deflationary. No one really believed it. Well, now it's back up to about 2.63%. So again, what I'm guessing is you're just going to see a lower high on this, and it should top out at a lower level than it did back over here and then go back down. We also have recreation. This is one that is finally starting to come down. Okay, I mean, this one stayed up elevated a lot longer than most, but now it's all the way down at 1.51%. So this category is actually lower than the Fed's target, because the Fed's target is just 2% overall. This one is actually at 1.5%. Education and communication has just basically been right around 0 to 0.5% for a while. And then finally, other goods and services. This is one that is amongst the stickier components, but it is also starting to weaken here, as it just dropped from 4.7% down to 4.27%. So, if you're looking at charts like copper and cocoa and various commodities, and you're wondering why, if they're going up, why is inflation not going up? It's because there are other sectors, right? There's housing, there's other goods and services, there's food and beverages, and I mean, by the way, the retail sales report we got this morning showed a little bit, I believe in some sectors, showed a little bit of weakness in the consumer. Not all, but in some of them. So that is where inflation year over year per category comes from. But you also have to remember that even though there is inflationary pressures in some categories, they're not all weighted the same when calculating out headline CPI. In fact, if you go and take a look at inflation year over year approximation of contribution per category, you'll notice that this green bar accounts for a lot of the headline inflation, and that is primarily coming from housing. So headline inflation is at 3.36%. Housing is more than half of that, right? It's at 2.06 of the 3.36. So again, if housing inflation continues to come down, then it would suggest it would be a drag on headline inflation, right? Headline inflation is at 3.36%, and a lot of that is just simply coming from the housing sector. So that is not a huge component. The food and beverages housing is a huge component. Food and beverages is not. I mean, while food and beverages has been going down, you can see that it only accounts for about 1/10 or so of the entire headline inflation. So not a big change there. Apparel essentially accounts for, it's negligible when really looking at headline inflation. You can barely even notice it. If you were to look at transportation, that's a little bit more noticeable, but still it's only at 0.582 of the 3.36. Noticeable, but not as big of a deal as maybe housing is. Medical care is relatively low in terms of its contributions there. Recreation, relatively low. So it's coming down, but it doesn't have a huge contribution. And then education and communication, I mean, you can barely see it. Other goods and services, pretty low as well, right? Only 0.11. So again, a lot of it is coming just from housing, which perhaps would explain why, if you are seeing, if you have seen oil go up, and if you have seen copper go up, and if you've seen things like chocolate, cocoa and other things go up, like, why is inflation coming down? It's because there's other categories, and it's also not weighted the same. We can also go over to core inflation. So if you look at core inflation, we're going to go figure out what the core inflation or expectation was going into this meeting, or into the report. And you can see that consensus was at 3.6, and it came in at 3.6, and prior was 3.8. So if you go look at it, it came in at 3.62. This one continues to just sort of slowly bleed down, which is a good thing. I mean, it's just sort of a slow downtrend here, and hopefully that trend ultimately continues. The monthly change on it hasn't been as drastic as it was before, but at least it didn't increase like last month. It was a decrease in core inflation, which I'm sure is welcome news for the Fed. Obviously, it's still a lot hotter than they want it to be, but it is at least moving in the right direction. And if you think about it, last year, there was a big drop in headline inflation really going into the summer. So I wouldn't be that surprised if out in Q3, we're starting to see headline inflation drop potentially closer to that 3% level, and maybe we'll even see it go sub 3% sometime later on this year. Again, until the Fed pivots, I would expect that there is still going to be a drag on inflation. I know it's slow, but it doesn't mean it's not happening. And remember also, we never said that it was going to go down in a straight line. We said it would be a stochastic process. And if you look at a 7-month moving average of it, I mean, you can see that it has just been slowly going down. bumped up a little bit right here, but then it's just started to potentially go down again. So be aware that headline inflation, core inflation, they are down a little bit from the prior month, still in line with expectations. And the other thing to mention here is that if you were to look at something like the U.S. Fed funds rate minus the inflation rate year over year, you'll notice that, I guess I was looking at this once upon a time, you'll notice that it's actually still pretty elevated. So what this essentially means is if you think about like the Fed funds rate at 5.5%, that's not really, that's not really the risk-free rate. Like the risk-free rate would be that minus, or it is the risk-free rate. But what I'm trying to say is that it's not, it's sort of the nominal, right? It's not the real return. If you're getting a CD or a T-bill and you're earning 5%, but inflation's at 3%, then your real return is only 2%. Okay? So what you have to do when you calculate out your risk-adjusted returns is you subtract out, as part of your Sharpe ratio, you have to basically subtract out the risk-free rate, which again right now is 5.5%. But remember, it's not the real. It's not that in real terms. In nominal terms, that's what it is. But in real terms, the interest rates are essentially right at around 2.1% because inflation is still over 3%. So you have to account for that. And so this is something that as inflation comes down, right? As inflation comes down, probably later this year, this will likely continue to go up if the Fed is not cutting rates. So if inflation were to drop to say, 2.5%, and the Fed funds rate stays where it is at 5.5, then this would go to 3. Okay, it would go up. So in order to maintain, the same monetary policy stance during a disinflationary trend, the Fed would have to cut rates. If they don't cut rates during a disinflationary trend, then that could actually lead to, to a deflationary crash, basically. And it could lead to really tight financial conditions if they're not willing to cut rates as inflation comes back down. So this is a big move that you've seen in this. For a long time, it was just basically going down, but now it's actually, sort of broken up here. Again, I'm not suggesting that you should do any type of technical analysis on this. I was just looking previously at this downtrend in terms of, where was your real return? And now it's back above 2%. And it's probably going to go up if the Fed doesn't cut anytime soon. Okay. I think the Fed's probably going to cut this summer. And the reason is because I think that, if you look at things like the labor market, like job openings, it does seem like it's coming into better balance. And, a lot of these things, right, when you think about like these different categories, a lot of them kind of show you how inflation has remained sticky. Job openings for a lot of these categories have been fairly sticky for about a year. Like they haven't really gone that much lower than where they were last summer. And also inflation hasn't gone much lower than where it was last summer. And that's why, Powell continues to say they will stay the course until the job is done. And the job just isn't done yet. Again, I do think they will probably pivot this summer. I really do. I think that they will. And the reason for that is I think that the consumer is starting to show signs of weakness. A lot of that could be seen in things like the dominance of Bitcoin, which is something we've talked about a lot. And I've said previously that, after it breaks through 56%, which it already did previously, that it would likely mark a transition into a risk-off phase where altcoins especially bleed back to Bitcoin, but also potentially go down in their USD pairs. And you can see that, things like ETH Bitcoin keep on putting in new lows. And so remember last cycle, it was when alt Bitcoin pairs, and this is something I was talking about earlier, but it was when alt Bitcoin pairs broke down right here in June, and then the Fed pivoted 1 month later. Alt Bitcoin pairs, I think, might break down either in May or June. So it's not that long. And if you're someone who is saying, well, ETH Bitcoin, if you think that ETH Bitcoin is the only thing that looks weak and your altcoin's doing well against ETH, just remember one thing, and that is that last cycle, ETH Bitcoin actually topped out, and then alt Bitcoin pairs went up for a couple more weeks or so and then rolled over. They followed ETH's lead. And I think the same thing is happening now. You're seeing ETH Bitcoin find this local top from a few weeks ago. It's been capitulating, and now it just keeps on putting in new lows. And I think you're seeing alt Bitcoin pairs follow suit, as alt Bitcoin pairs are potentially getting rejected here by their bull market support band, which is what I said. I mean, I said I think alt Bitcoin pairs will roll over in mid-May, and it looks like that is what is potentially happening here. It looks like alt Bitcoin pairs are rolling over. And again, going back to these other ideas that we've talked about a lot, the Bitcoin dominance, I said back a month ago that you're likely going to get a dip after it sweeps this high that should last about 5 to 6 weeks before breaking to new highs. And you can see that we're currently in week 5 and we're approaching the prior high, right? So I think that Bitcoin dominance is going to continue to go up into this summer. And I've explained that many times. And so be on the lookout for that. And I think a lot of that is how the market is reacting, right? Yes, Bitcoin is up today, obviously, it's back to, to 64K, 64 to 65K, which I know people are excited about. But I think the real story right now is the fact that ETH Bitcoin keeps on bleeding and putting in new lows, which in 2019 was an ominous sign for the altcoin market. Again, the altcoin market did not immediately believe it. In fact, a lot of people thought that ETH Bitcoin was just sort of dying off and that other newer altcoins would take over and become ETH killers. But in reality, ETH Bitcoin was giving the warning to the altcoin market for those who cared to listen. It's just that most of those people did not care to listen, and they thought their altcoin was going to do well against ETH because ETH Bitcoin was capitulating. And then a couple weeks later, it also turned out that their altcoin started to capitulate against Bitcoin as well. It just didn't get the memo as quickly. ETH Bitcoin often gets the memo. It shows you what is happening in the altcoin market. It's just that the altcoin market can kind of run to the extremes a little bit easier, right? It'll go up a little bit longer, go down a little bit more, but this is what we've normally seen in prior cycles, is that ETH Bitcoin shows the weakness and then alt Bitcoin pairs follow suit. So, I mean, it's a good thing that inflation came back down, but the reality is that even though it came back down a little bit, the market is still not looking for price or for rate cuts anytime soon. Again, I think we're probably going to get some this summer, but right now there's a 96.9% chance the Fed does not cut in June. If I were only looking at alt Bitcoin pairs, if they were to break the range low in May, then I would say the Fed should cut in June. If they break the range low in June, then I'd say the Fed should cut in July. But again, I don't know exactly when it's going to break down, but I could see this. I really do think all Bitcoin pairs are in the process of rolling over here and breaking down. And, Bitcoin, when you see these big moves by Bitcoin, a lot of that reason is because other cryptocurrencies are breaking down. If someone thought that ETH Bitcoin had bottomed back in April with the halving, there's a lot of people that thought that, and they explained their reasoning, but I always said I think monetary policy plays a bigger role. Now that we took out that low, we're at a new low now, those people have to go back to the drawing board, and then maybe they capitulate and say, all right, Bitcoin is a better place to be. And so that leads to Bitcoin going back up in the short term, right? This is a long process. Remember, it's a long process. And last cycle, basically this process went on and on and on until Bitcoin dominance retraced to the 0.618 fib retracement. And then after it retraced that right here, then Bitcoin USD also eventually then about a month later fell below its bull market support band, while ETH obviously is already below its. So again, that's where we are right now in the cycle. And I really do think that, we're going to see Bitcoin dominance explode to the upside this summer. I think it'll probably top out this summer, Bitcoin dominance. I think ETH Bitcoin might bottom out this summer. But that's where we stand. And that is your update on inflation and so on and so forth. So if you guys like the content, make sure you subscribe, give the video a thumbs up. And again, check out Into the Cryptoverse Premium at intothecryptoverse.com. I'll see you guys next time. Bye.